Welcome back to The Explainer. Today we're unpacking a fascinating, highly opinionated indictment from the YouTube channel Casual Finance. The creator over there presents a pretty fiery argument, basically categorizing the entire cryptocurrency industry as a modern-day scam. To set the tone right out of the gate, the source compares crypto to a terrible Tinder date. You know, the kind of guy who calls himself an entrepreneur but is really just selling solar panels door to door. It's a bold claim for sure, and we're going to break down exactly how they build this compelling case.
Okay, let's dive into this with a clear roadmap. We'll be systematically unpacking the creator's argument by looking at these 6 specific pillars. 1. The digital utopia promise. 2. The utility illusion. 3. A volatile speculative asset. 4. The meme coin graveyard. 5. The stablecoin collapse. And finally 6. The FTX implosion.
Section 1. The digital utopia promise. From eCash to Bitcoin.
So the source begins by taking us all the way back to the original decentralized vision of crypto. Because remember, it wasn't initially pitched to the public as some massive get-rich-quick scheme. The original vision was deeply ideological. It was supposed to be this government-free, essentially bank-hating financial utopia designed to just bypass the traditional financial system entirely. Back in 1983, a guy named David Chaum introduced the concept of eCash, which was an anonymous electronic money system. It kind of lingered quietly for decades until 2009, when Satoshi Nakamoto mined the very first Bitcoin and officially launched this decentralized dream. But as the source argues, when we fast forward to the present day, we're hit with a massive reality check. The utopian promise of a currency for the people stands in really stark contrast to what the industry has actually morphed into.
Moving on to Section 2. The utility illusion. Does it actually work as money?
The creator poses a really critical, practical question here. Does cryptocurrency actually function as money? If you want to use Bitcoin for everyday necessities, like say buying your weekly groceries, grabbing a cup of coffee, or paying your rent, the statistics are pretty stark. Out of an estimated 350 million businesses worldwide, a minuscule 18,000 actually accept Bitcoin as a direct currency. The source argues that, statistically speaking, this adoption rate is basically zero. And what's more, the companies that do accept it usually rely on payment processors that instantly convert the crypto into US dollars the literal second the transaction goes through. So, the big takeaway here is that genuine, widespread adoption as a standalone currency, it simply hasn't happened.
And this brilliantly illustrates the creator's point with a sharp, hilarious analogy. They say, technically, you could mow your lawn with nail clippers. It perfectly drives home the argument that, sure, while Bitcoin can theoretically be used to buy goods, its extreme price volatility, massive transaction fees, and huge exposure to fraud make it an utterly exhausting and impractical payment system for daily life. Section 3. A volatile speculative asset. Investment or gamble.
So, if it isn't functioning effectively as real-world money, what exactly is it? Well, without everyday utility, the source argues, Bitcoin operates strictly as a speculative asset. Its price is driven entirely by market supply and demand. Just look at the numbers. Bitcoin's annual volatility sits at around 60%, compared to the US stock market's historical average of about 15%. This means crypto is roughly 4 times more volatile than traditional stocks. According to the analysis, this massive risk perfectly explains why fiduciary money managers, the professionals legally obligated to make sound financial decisions for you, typically only recommend a tiny 1 to 2% allocation to crypto.
The source underscores this heavy institutional skepticism with some pretty blistering critiques from the titans of traditional finance. They mention Warren Buffett, who famously called Bitcoin rat poison squared. Yikes. And then there's Jamie Dimon, the CEO of JP Chase, who bluntly stated, Bitcoin does nothing. I call it the pet rock. The overarching argument being made here is that institutional investors treat crypto like a total gamble because fundamentally it has absolutely no underlying intrinsic value.
All right, Section 4, the meme coin graveyard and the illusion of picking winners.
Now, what's really interesting about this slide is what happens to the everyday retail investors who are just hoping to pick that one winner that skyrockets to the moon. The source paints a really harsh reality, basically comparing the current crypto environment to a Discord-fueled casino roulette table, completely built on the illusion of easy wealth. Just look at the staggering scale of the failure rate. Based on data from CoinGecko, which is a platform tracking over 7 million coin listings since 2021, an astounding 3.7 million of them are now officially considered dead. Think about that. Over half of all the cryptocurrencies they tracked haven't just dipped a little in value, they have gone completely to zero.
The source sharply contrasts traditional market bankruptcies with crypto project failures, and this is absolutely crucial for your own financial safety. When a publicly traded stock goes bankrupt, you might at least have a potential legal claim on the company's liquidated assets to recoup some of your losses. But when a crypto project fails, usually because the developers pulled the liquidity in what's known as a rug pull, investors are left with absolutely nothing but a JPEG logo of a meme coin and total radio silence. It's emphasized as an asset class where your hard-earned money can just disappear overnight without a single shred of legal recourse.
Section 5. The stablecoin collapse when the safe bet fails. Okay, so in response to all that wild unpredictability, the crypto industry offered a supposed solution: stablecoins. They were heavily marketed to everyday investors as the cryptocurrency equivalent of a reliable, traditional savings account. Just to ensure we're all on the same page, let's clearly define what a stablecoin actually is. It is a cryptocurrency specifically designed to stay tied to something stable, usually the US dollar. The baseline promise here was pure safety, a reliable harbor from that crazy 60% volatility we talked about earlier. But the source asks us to examine how this foundational promise catastrophically fell apart.
The creator breaks down the algorithmic mechanism of a massively prominent stablecoin project known as Terra and its sister token, Luna. It functioned in continuous automated steps. So if Terra fell below $1, the system would mint more Luna to raise Terra's price. If Terra rose above $1, the system would burn Luna to lower the price. Now, the analysis notes this complex financial engineering sounded totally brilliant in theory, but it proved to be incredibly disastrous in practice.
$45 billion. In May 2022, Terra lost its tie to the dollar. The entire algorithmic system just imploded during mass sell-offs. In just one single week, this supposedly safe asset collapsed, completely wiping out an incomprehensible $45 billion of investor wealth. Regulators literally labeled it one of the largest wealth destructions in modern financial history.
Section 6. The FTX implosion. The fall of crypto's white knight. Let's move to and see how this builds. Because if the coins themselves aren't safe, what about the massive institutional exchanges where they're actually traded? FTX wasn't just any exchange. People saw it as the crypto equivalent of the New York Stock Exchange. They possessed massive credibility markers that built the ultimate illusion of safety. We're talking Super Bowl advertisements, A-list celebrity endorsements, stadium naming rights, and serious backing from legendary financial firms like BlackRock and Sequoia Capital. To the general public, they looked completely invincible.
But the source outlines the stark reality of the massive fraud occurring behind closed doors. FTX was secretly stealing its own customers' deposits. Those funds were being illegally funneled into its sister hedge fund, Alameda Research, where executives were making massive, incredibly risky bets with money that simply did not belong to them. When it all unraveled, the reality of the exchange's internal operations literally shocked the world. John Ray, the bankruptcy executive famous for cleaning up the massive Enron scandal, took over FTX and stated, "Never in my career have I seen such a complete failure of corporate controls." That quote right there really cements the catastrophic reality of the exchange and the complete, utter lack of oversight in what was once crypto's most trusted institution.
And that brings us to the final verdict: greed in a new costume. The source's ultimate conclusion is that despite the bankruptcies, the rug pulls, and the millions of retail investors whose life savings were totally obliterated, the crypto industry survives. But according to the creator, it doesn't survive on real-world utility or trustworthy innovation. No, it survives on cyclical hype, pump and dumps, and blind optimism driven by pure greed.
So, we are left with this wildly provocative question drawn directly from the source's critique. Is cryptocurrency truly the future of finance, or is it just a digital mirage that disappears the second you reach for it? Whatever your stance is on the technology, the evidence presented by the critics demands attention. Thank you so much for joining me for this explainer. I really encourage you to reflect on these arguments, explore the underlying tech for yourself, and above all else, keep asking the hard questions. Catch you next time.